Hello, fellow trader. Whether you're just starting out or you've been in the markets for years, there's one thing that separates consistent winners from the rest: understanding and respecting key levels on your charts. Today, let's talk about the foundation of successful trading: key levels. These are the invisible lines that can make or break your trades, and mastering them is the first step toward real trading confidence. Forget fancy indicators and complex algorithms for a moment. Strip your chart down to the basics and you'll see what really matters. The most powerful information is already on your price chart, if you know how to read it. Every candle, every swing, every pause tells a story about buyers and sellers. Key levels are areas where price has reacted in the past. Think of them as strategic battlegrounds. These are the places where the market has made important decisions, and where it's likely to do so again. Imagine your chart as a map, and these levels as hills and valleys where major battles between buyers and sellers have taken place. The more times price has reacted at a level, the more significant it becomes. By marking these levels, you create a plan and avoid random, low-probability trades. You're no longer guessing. You're preparing for what the market might do next. This structure gives you a logical reason for every action you take. It's like having a roadmap that keeps you from getting lost in the noise and chaos of the markets. The first thing I do on any chart, gold, stocks, currencies, is zoom out and mark where price made significant turns. This gives me a bird's-eye view of the market's history and helps me spot the most important zones. Draw horizontal lines at these points. This simple act can transform your trading. Suddenly, you'll see patterns and opportunities that were invisible before. It helps you focus on what matters: price action at areas watched by institutions and professionals. These are the levels where big money steps in, and where the most explosive moves often begin. These aren't just lines, they're zones of potential conflict. Think of them as the front lines in the ongoing battle between bulls and bears. When price approaches these zones, pay close attention. Watch for signs of rejection, breakout, or consolidation. These clues can give you a real edge. This approach works on any market, any time frame, but start with higher time frames like the daily chart. The higher the time frame, the more reliable the level. Before anything else, identify your key support and resistance levels. These are your anchors, the reference points for every trade you consider. This is your context for every trade idea. It's what separates a random guess from a calculated decision. Without it, you're trading blind, reacting to noise instead of anticipating major moves. You'll find yourself chasing price, getting whipsawed and losing confidence. Make it a habit. Open your chart, mark your levels, and let them guide your decisions. Over time, you'll notice your trading becomes more disciplined and less emotional. This is the first step toward trading like a professional. Don't skip it. Even the best traders in the world start their day by marking levels. Let your levels be your guide. They'll help you stay patient, wait for the right setups, and avoid costly mistakes. That's how you build a solid trading foundation. Start with levels, and you'll be amazed at how much clearer the market becomes. Let's break down the two most important types of levels: support and resistance. Support is where buying pressure stops price from falling. Think of it as a floor. Resistance is where selling pressure stops price from rising, a ceiling. When price hits support, it often bounces. At resistance, it often reverses. These aren't exact price points, but zones. Price can dip below or poke above before reacting. Draw them as areas, not thin lines. These zones are psychological battlegrounds, reflecting the market's collective memory. They show where traders have made big decisions before, and likely will again. Spotting these zones helps you anticipate turning points, not just react. Prepare for action at these battlegrounds, not in the middle of nowhere. This is how consistent traders stay ahead. Let's get practical with a gold chart example. First, identify key structure. Look left for obvious reaction points. Suppose we spot strong support at $3,245 where buyers have stepped in before. Mark this area as key support. If price drops to $3,245, it's a high-interest zone for a potential buy. But don't jump in blindly. Wait for confirmation that buyers are in control. If price breaks below $3,245, that's a signal sellers are winning. In that case, look for the next support, maybe at $3,120, and shift your bias to bearish. Always have a plan for both scenarios, bounce or break. This rules-based approach removes guesswork. Mark your levels, wait for price action, and let the market show you who's in control. That's how you trade with clarity. Simple, logical, and effective. Now let's add the trend to our analysis. Understanding the market's direction is crucial for making informed trading decisions. Trends reveal the underlying sentiment, whether buyers or sellers are in control, and help you avoid fighting the market's natural flow. The trend is your friend is classic advice for a reason. It reminds us that trading in harmony with the prevailing direction increases our odds of success. Instead of guessing tops and bottoms, we ride the wave that's already in motion. Trading with the trend means you're moving with the market's momentum, not against it. This approach helps you catch bigger moves and reduces the risk of getting caught in sudden reversals. Identify the trend: uptrend, where price makes higher highs and higher lows; downtrend with lower highs and lower lows, or a range where price moves sideways. Recognizing these patterns is the foundation of trend trading. If gold is in a strong uptrend, look for buys on pullbacks to support. These pullbacks are often temporary pauses before the trend resumes, offering strategic entry points with favorable risk to reward. For example, if the long-term trend is bullish, a pullback to $3,245 is a high probability buy. This level acts as a magnet for buyers, and entering here means you're trading with the crowd, not against it. When key levels and trend align, you have a powerful setup, what we call confluence. Confluence increases your confidence, as multiple signals point in the same direction. If price breaks key support, it could signal a trend change. Be ready to adapt. Markets are dynamic, and trends can reverse quickly, so always stay alert. Don't be stubborn. Let price action guide your bias. Flexibility is a trader's greatest asset, allowing you to respond to new information as it unfolds. Be a chameleon, shift with the market, not against it. Adapting your strategy keeps you in sync with the market's rhythm and protects your capital. Look for setups where level and trend agree. These are the moments when the odds are stacked in your favor, and your trading plan comes to life. That's where your edge lies. Stay flexible, stay objective. Let the market lead, and you'll find yourself riding the momentum with confidence and clarity. With levels and trend in place, you need a trigger, a reason to enter now. This is where candlestick patterns come in. Patterns like pin bars, hammers, or bullish engulfing candles at key support signal buyers stepping in. But context is everything. A pin bar at a random spot means nothing. Only act when a valid pattern appears at a key level, in line with the trend. Your formula: key level plus trend alignment plus candlestick trigger. All three must align for a high-quality setup. Don't trade on patterns alone. Location and context matter most. This disciplined approach separates pros from gamblers. Wait for the market to give you all the signals. Only then, act decisively. Protect your capital by being selective. That's how you stack the odds in your favor. Patience is key, but waiting doesn't mean doing nothing. If gold isn't at your level, scan other markets: Forex, Indices, Commodities. Diversification keeps you engaged and increases your chances of finding A-plus setups. Apply the same principles: mark levels, identify trend, wait for a trigger. This approach frees you from emotional attachment to one market. You become an objective opportunist, not just a gold or Forex trader. Diversifying your watch list makes you a more well-rounded trader. Your job is to find high-probability setups wherever they appear. That's how you stay patient and productive. To trade multiple markets efficiently, you need the right broker. Choose one that offers a wide range of instruments on a single platform. This streamlines your workflow and makes risk management easier. Look for competitive spreads, low commissions, and reliable execution. Make sure the broker is well regulated for your safety. Do your research, read reviews, compare offerings, check regulation. The right broker is your trading partner, enabling your multi-asset strategy. Choose wisely for long-term success.